Hi guys, I'm Dan, this is Kai, we're the directors at Crescent Mortgages, and today we're going to be bringing you a beginner's guide to mortgages, specifically in the UK. If you're thinking about getting a mortgage or you just want to understand the basics, maybe you're thinking in the near future this is probably the right place to start. We're going to be explaining a bit more about the process that you might want to go through, where to start as far as finding a mortgage, and also kind of explaining some of the jargon and some of the things you need to think about and consider if you are looking to get a mortgage in the future. So let's jump into it. What is a mortgage?
Simplistically, in terms of what you need to know, it's just a loan secured on a property, I think.
Yeah.
A mortgage is something that most people need to take to buy a property. If you're not lucky enough to have the money in the bank already, you need to borrow money from a bank or building society to purchase the property.
What do you mean by secured? What do you mean it's secured on a property?
So secured means if you do not pay that mortgage, so your monthly payments on the mortgage, if you don't pay it, then the bank are entitled, the building society are entitled to take that property from you. So you have to keep up your payments to make sure that you keep your property. Once you've paid the mortgage off, there's no bank securing anything, then it's all yours.
I guess first of all, we're going to just touch on the kind of the process. So if you want to obtain a mortgage at any point, now or in the future, here's what we think you should do. First of all, and we're going to kind of rattle through this, we can go into a bit more detail at the end or in other videos, but we're just going to rattle through the process. So first of all, we believe find a good mortgage broker. You can try and shop around yourself, you can go directly to your bank or building society, but a mortgage broker will have access to pretty much all of them. They can do all of the work, they've got the tools, the experience, the contacts, which you just don't have. So it's going to be so difficult for you to shop around the entire market without the help of a mortgage broker. Some mortgage brokers, such as ourselves at Crescent Mortgages, are fee-free. So there's no catch, they'll do all of the work for you, they'll be paid by the lender at the end of the process, and you won't pay them a penny. So it's kind of win-win for you. Once you've found a mortgage broker, tell them what they should do.
Well, next you would want to know what you can borrow and what it looks like. So get an agreement in principle, you'll often hear.
AIP.
AIP, or decision in principle.
DIP.
Exactly.
Or a mortgage in principle. It's the same thing. They've all got the same name, but it basically means you've spoken with a mortgage professional, you've given them some of your information, and they've confirmed that you should be eligible for a mortgage, you're likely to achieve a mortgage, and how much you can borrow. Once you've got that, you'll be in a much stronger position to start looking for properties and work out what you can get within your budget.
And then from there, you will go and look for a property. Try and find somebing you like, get in touch with estate agents, view properties, and subsequently put in offers and have an offer accepted at some point. Nice and straightforward. That's the bit that should be good fun.
Yes, a lot of people, once they've got the AIP from the broker, which can sometimes just be a 20-minute conversation, they find it hard to believe that they're now in a position where you can start going and looking at properties. But that's once you've got that and you've got the AIP, you can go and start to look for properties, and if you like it, you can make an offer on a property. But the AIP certificate, the agreement in principle certificate, a lot of estate agents are going to ask to see that before they let you make an offer on a property. So that's why you want to try and get that certificate, which we'll send over to you. Until you've got that, some estate agents may not take you seriously, or they may not let you view or offer on a property. Once you've found the property and your offer's been accepted, that's when kind of the actual mortgage process and application gets underway. So I guess we would, as a broker, you'd come back to your broker, tell them that you found a property. We would then find you the best mortgage on the market that you're eligible for, obviously based on your specific requirements and circumstances. You then need to pick a solicitor, so you will need a solicitor to oversee the purchase for you. Most brokers will have a solicitor or a panel of solicitors that they work with, so we can recommend someone to you, or you can shop around yourself. As long as they're on the lender's panel, you can use whichever solicitor you want, but make sure you pick a decent one because they do have quite an important role in the process.
And from there, once you've got your solicitor, you've spoke to your broker or your bank, and you've got the right product, you apply. You apply for your mortgage at that point.
You apply?
You apply, or we apply for you.
So your broker will submit the application for you, and they will take care of most of that process and the documents for you.
And there are steps after that, but we don't want to...
Now's not the time, is it?
No, not really. And once you get to that stage, you will have been explaining the process further from there. But essentially, in your whistle stop, once you've applied, it will go through a few more stages: mortgage offer, solicitors, keys, if you will, very simplistically.
So these are some of the key points that we will explain to clients when we have that agreement in principle conversation. So when you first come to us, you're interested in getting a mortgage, you want to find out if it's achievable, you want to find out how much you can borrow before you start to go look for properties. During that conversation, that's a good opportunity for us as a broker to give you some kind of important information of what to expect. Partly so that you know what to expect, and partly because some of it will be applicable to your property search and obviously budgeting and that kind of thing. So I guess a couple of things, maybe touching on just explaining a bit of jargon as well. So when you buy a property, 99% of the time you will need a deposit. So you'll need to have saved deposit yourself, or whether you've got it in investments, whether that's coming from a gift from a family member. There are certain kind of sources of deposit that are or are not acceptable, but savings are normally fine, investments are normally fine, a gift from a family member is normally fine. Generally, the size of the deposit, you think at least 5%, but the bigger the deposit, generally the better. So the bigger the deposit you have, you'll find you're probably going to get better interest rates, and the lender's criteria and affordability assessment might be a bit more lenient. So you might find that things are a bit more comfortable. So a minimum of a 5% deposit, but if you've got 10%, 15, 25% or more, that does put you in a slightly stronger position. But if you've only got a 5 or 10% deposit, it's not the end of the world, but make sure you kind of, you speak to your broker about that, just so they can start to work out how that might impact things. And as far as the jargon, so that relates to LTV. You will almost certainly hear the term LTV throughout the process. What does LTV mean?
Well, it means loan to value, and it essentially is the proportion of deposit and mortgage. So 90% loan to value, for example, would have a 90% of the property value is mortgage based, 10% is the money you're putting in. We do have an entire video on it as well.
We do, yeah. So you can check out our previous video on loan to value. But yeah, essentially, if you're buying a property for 100,000, if you put down £15,000 on the deposit, that's a 15% deposit. So your mortgage is 85%. So your loan to value in that scenario would be 85%. And generally, the lower your loan to value, the better, because it means that you're putting down a bigger deposit, you've got more equity, which puts you in a slightly stronger position. So sometimes the lenders will reward you, like I say, with better rates and slightly more lenient criteria. Second thing you'll need to determine, which again, you don't need to do just yet, this will be decided once you found a property, is picking
scheme or product, depending on...
You'll hear the term scheme, product, but what does it mean?
So generally you'll get two types. You'll get fixed or variable at a higher level, and then you'll get longer or short-term versions of each of those. And this is determining now what the product will be, an interest rate for a specified period of time. So you might see a fixed rate for 5 years. So you are picking a rate that you will pay for the next 5 years. And it'll be a conversation around what you need to have, what suits you.
What we think the market might do.
Exactly.
What your plans, how long you'll be in the property.
Loads and loads of factors to determine the best rate, the right scheme, right product, are all the same thing, really. And trying to make sure that it's right for you. And again, that's a two-way conversation. That bit, it's very important that it's two-way.
Yeah, we can guide you, but we're also keen to know what your plans are, so we can help kind of give you the right advice. Outside of that initial scheme, you will also hear the term. You hear the word term. So the term of the mortgage is how long you spread the debt over. So if you take the mortgage over a 30-year term, it means that you will pay the mortgage off over that 30 years, and at the end of the 30 years, providing you've taken out a mortgage which pays the interest and pays down the capital, which for most people that's what you go for, at the end of the 30 years you'll be mortgage free. So most lenders will let you take the term up to 35 years, some even 40 years as the longest. And you can take the term pretty much as short as you want within reason, but realistically, you're probably not going to take the mortgage over a 5 or a 10-year term, because for most people, the payments are going to be too high unless you've got a particularly small mortgage. So it's quite common for first-time buyers to take the mortgage over 25, 30, 35, 40 years, but it's completely up to you. The longer the term, as you can imagine, the lower the payment, because you're spreading out the debt. But although that obviously might seem appealing to you, obviously the longer the term, the more interest you will pay overall, and obviously the longer you'll have that mortgage to an older age. So if you can take the mortgage over a slightly shorter term and you can afford the payments, sometimes that's the way to go. But again, it does depend on everyone specifically, doesn't it?
And the term is changeable. So whilst you might pick you're buying your first property, you're young, you expect your income to go up, etc., you might then take a 35 or 40 year mortgage to start with, but as time goes on, you can reduce that. So
you can overpay.
Yeah, you can overpay. There are lots of ways to bring it down. So a lot of people do start a little further out and reel that in, if you will, as time goes on.
That's a really good point.
And I was just going to say the scheme in turn, kind of to tie in. If you imagine we discussed schemes, 2 years or 5 years. We just talked there a 35-year mortgage. You would have a product from year 1 to year 5, and then you would have another product when that finishes from year 6 to year 10, let's say, another 5-year fix or whatever. So you dot around products throughout the lifetime of the mortgage, or the term.
Which is a remortgage. So if you're taking the mortgage over a 35-year term, you've initially picked a 5-year scheme, then at the end of that 5-year scheme, you would remortgage and shop around and remortgage to a new lender onto a new scheme for potentially another 2 years or another 5 years. And you'll probably do that every few years throughout the 35-year term of the mortgage. So scheme and term are different. They get confused sometimes, but they are different things. The scheme is the initial product. The term is the entire term that you spread the mortgage debt over. Common one is arrangement fee. So this is a fee that a lot of lenders and a lot of schemes have. Typically £1,000, but they can be smaller, they can be bigger. And people say, what's it for? It's not really for anything, is it? It's just an additional payment that you have to make to a lender to get that particular product. Now, although no one likes fees, if you pay an arrangement fee, it does often get you a slightly better interest rate. So it might be that by paying a £999 fee, you get a lower rate for, let's say, 5 years. So actually it could be cheaper to go for that scheme because you more than save that £999 fee back over the 5 years, but your broker will calculate that for you. The arrangement fees can normally be added to the mortgage. You don't have to do that, but if you don't have the money to pay that up front, it can potentially be added to the mortgage, which will bump up your payment by a couple of pounds depending on your mortgage term. Survey valuation, what's the difference?
Yeah, survey valuation. There isn't really one. There is one that you need to know, I would say. Valuation, survey, you'll hear different people in the process call it different things. Really, the main purpose from the mortgage perspective is the lender will value the property or survey the property to give it a value and therefore say it is worth 200,000, which was the price you agreed. For example, you can have your own surveys done. They are more detailed and potentially needed if you're buying an older property or something. But again, it's a conversation you get into more specifically.
Yeah.
When you know what you're buying.
The mortgage valuation, that's a kind of a mandatory part. Any mortgage you apply for, the lender will want to do a valuation to make sure that the property is in reasonable condition and you're paying a fair value for it, because obviously they have an interest in the property because they're going to be securing the loan on that property. That's mandatory. If you want an additional, more comprehensive survey, which you might choose to do because you're buying this property, you're taking the risk on this property, and you want someone to look at it in real detail to make sure there are no major issues before you legally take ownership of the property. You don't have to do that. That's not mandatory. That's discretionary. That's completely your choice. If you want to organise a survey, you're welcome to do that. And we do sometimes encourage people, if you're buying a property, especially if it's a slightly older property, if you want to pay a bit just to kind of, have someone look at the property in more detail, you're more than within your rights to do that. And that's quite common. But yeah, so that's generally what a survey, again, they're interchangeable, but a survey generally is what you would organise privately. A mortgage valuation is the mandatory valuation carried out by the lender.
And often free. The mandatory one.
Often free. Sometimes you pay a little bit, but these days they are normally free, aren't they? Yeah. I think, again, it's hard to know kind of how much depth to go into at this point. We don't want to drown you, but I think that is a good starting point. I think because everyone's situation is different, I think the first couple of points we highlighted of find a good mortgage broker, that is a really, really good place to start. They're going to be able to answer all of your questions, give you the guidance and kind of, get into your particulars rather than this, which is a bit more of a kind of a generic overview, isn't it?
Yeah.
Any questions, leave them in the comments, or you can give us a call, head to the website, drop us a message if you need anything at all, or if you want that initial kind of agreement and principle conversation. But otherwise, good luck with it, and we'll see you next time. Thanks a lot.